Okay, hi everyone. Welcome to today's webinar. So for today's session, we are going to be talking about RSI and stochastic oscillator. There was a change in the topic for today. And I know that the original topic was supposed to talk about setting up your trading journal, but we did touch on that a little bit last week, and also you guys have requested for this as well. So, yeah, we are going to be doing this topic instead for this session. Oh, can you guys hear me? Hmm. Okay, because if you guys can't hear me, just let me know in the chat. Because on my side, it looks fine. Can everybody hear me? Okay, I think everything is okay. If you can't hear me, try exiting out of the session and then joining again. And if it still doesn't work, just let me know. Okay, let's go ahead and get started. So as per usual, a disclaimer and risk warning before we get started. This information is not considered investment advice or investment recommendation, but instead a marketing communication. Risk warning, our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Okay, I'm Melanie, and I'll be your speaker for today. I'm an investment analyst at Rocket, who were finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. As I mentioned earlier, if you guys recently just joined, because I saw a bunch of you guys just join our session, so welcome. But this session was supposed to be about how to set up your trading journal, but we've changed it because of compliance issues and other issues as well. But I will touch a little bit on how to set up a trading journal at the end of this session as well, just in case you guys were here for that. So again, I'll still talk about the important points of how to set up your trading journal just at the end of the session. Okay, so for today's session, we are talking about the RSI and stochastic oscillator indicators, and this was highly requested by you guys last week. So we'll go ahead and start. So for today's session, here's our agenda. We'll start with an intro to stochastic and RSI, the difference between them, what is divergence, and then how to use divergence. Okay? Okay, let's get started. So how do you use the stochastic oscillator? Or rather, what is it? Let's start with this first. So what exactly it is it consists of two lines, the percentage case line that fluctuates, and they both fluctuate between 0 and 100. So the first line, the K line, represents the current closing price of the instrument, in relation to the high and low prices of a given period. The second line, which is the D line, is a moving average of K across a certain number of periods. So the difference between the slow and fast oscillator is the slow K incorporates a K slowing period of 3 that controls the internal smoothing of the K line. Setting the smoothing period to 1 is equivalent to plotting the fast stochastic oscillator. Okay, so let's just talk about how exactly to use it. So traders will typically use stochastic oscillator to identify potential buy and sell signals. So when K crosses above the D line, so oops, so we talked about the K line earlier. The D line is basically the second line, which is a moving average of K over a certain number of periods. Okay. So when K crosses above that line, it's considered a buy signal. And when it crosses below, it's considered a sell signal. So traders also look for divergence between the price of the instrument and the stochastic oscillator, which can indicate a potential trend reversal. So we'll touch a bit on that later. So the normal default settings for stochastics is normally 533. So readings that are greater than 80 indicate that the price is near its high. Readings lower than 20 indicate that prices are near the lows. A security is overbought when the K line moves above 80 and oversold when the K line moves below 20. So I've also added the formula for the stochastic oscillator in case you are curious, but this is normally automatically calculated for you on whatever platform you are using. So the stochastic oscillator, we've already touched on that. Now let's talk about a pretty similar indicator to the stochastic oscillator, which is the RSI. So RSI is a popular technical analysis indicator used in trading to measure the strength of a security's price action over a specified period of time. So it's commonly used to identify potential entry and exit periods in the market. So the RSI measures the magnitude of a security's recent price change to determine whether it's overbought or oversold. Okay, so how exactly do we use it? So if it oscillates between 0 and 100, um, above 70 is considered overbought and below 30 is considered oversold. When the RSI value is above 70, it suggests that the security may be overvalued and due for price correction, potentially indicating a sell signal. When the RSI value is below 30, it suggests that the security may be undervalued and due for price rebound. So oftentimes we will combine using the RSI and stochastic with other technical analysis indicators. That's kind of what we call confluence, and we'll touch a bit more on this later on as well. Okay, I just want to confirm that you guys can hear me. Just let me know in the chat. Because we had someone say that they couldn't hear me. Okay, I'll be right back. Okay, great. Okay, great. So now that we know how exactly to use the RSI and the stochastic oscillator, let's look at the differences between them. So the RSI and the stochastic oscillator are both price momentum oscillators that are commonly used. So they're most oftenly used in tandem, but they each have their different underlying theories and methods. So the stochastic oscillator is predicated on the assumption that closing prices should move in the same direction as the current trend. Meanwhile, the RSI tracks overbought and oversold levels by measuring the velocity of price movements. So in other words, the RSI was designed to measure the speed of price movements, while stochastic oscillator formula works best in consistent trading ranges. Okay, great. Thanks, everyone. So in general, the RSI is more useful during trending markets, and stochastic is more useful in sideways or range-bound markets. Okay, so here's what an example looks like on the RSI and stochastic looking at the same chart. So apart from the individual users, which I've already gone through, the K line above the D line or above the 80 or 20, so on and so forth, 70 and 30 for RSI. Excuse me. Another way that you can use um, the these two indicators is by looking at divergence. So what exactly is divergence? It's a technical analysis concept that compares the price or the movement of a security's price and an indicator. So specifically an oscillator like your RSI or stochastic to identify potential trend changes. So there are two types of divergences, bullish and bearish. Bullish occurs when the security's price makes a lower low, while the indicator makes a higher low. So this suggests that the downward momentum of the security is losing strength and a potential uptrend may emerge. So you can kind of see this. Let me move the image. But you guys can kind of see the bearish and bullish examples here. We also have the hidden divergence, which I'll get into in a bit, and also the exaggerated divergence. So on the other hand, bearish occurs when the security's price makes a higher high. So you can see here makes a higher high, while the indicator, so the red line, makes a lower high. So this suggests that the upward momentum of the security is losing strength and a potential downtrend may emerge. So it's important to note that divergence is a potential early warning sign of a trend change, but not a guarantee. So traders often use other technical analysis tools like trend lines or chart patterns, like I mentioned, other indicators as well, to confirm your divergence signal and make your trading decisions. So let's go through some examples of a bearish and bullish divergence. So in this example, we have price testing a key horizontal level with price making a smaller high, resulting in the bearish divergence with the RSI. So our descending resistance line on the RSI caught the past two reversals correctly. So it forecasts that we could be seeing a reversal here. Okay, so ultimately this is what happened. Price reverses strongly because of the horizontal resistance, also the RSI resistance, plus a bearish divergence as well. And we can see RSI has also reversed very strongly. Okay, let's look at another example. So this is also a bearish divergence. So here you can see price making a higher high, very slight higher high over here. and stochastic giving us a lower high. Okay, and ultimately this is what happened. Um, that's a repeated pattern with the bearish divergence occurring again and a repeated pattern here again. And there's a hidden resistance level as well. Okay, so we are forecasting prices to continue to drop, which is exactly what happened here. Okay, it reversed strongly off of that second bearish divergence. Okay, so now let's talk a bit about the hidden support and resistance levels. So if just to recap, previously we were talking about bearish divergence and bullish divergence. So now we're talking about hidden support and resistance levels, which are also around the same, using the same concept. So here, looking at this solely at the price chart, you can see price has made a higher high both times, and our stochastic has just reversed off of this consistent resistance level. So this is what we call a hidden resistance. Okay, now in this example, we have prices moving in this ascending trend line, and we also are observing a hidden support level. So prices are moving in this ascending trend line. You can see the higher low, whereas stochastic is just reversing off this support level. So this is our hidden support level, and we're expecting prices to continue towards our take profit. Okay, and that's exactly what happened. Okay, now looking at the divergence potential. Excuse me. Firstly, you have to always take note of where the bearish divergence started, as this is the level where it would tend to reverse to. So we have prices moving in this bearish divergence, price making a higher high, RSI making a lower high. Okay, so price reversed to exactly where the divergence started to occur. Okay, now let's talk about forecasting breakouts. So here we have prices moving in this ascending trend line. RSI is also moving in an ascending trend line. You can see RSI helped us to identify price breakout of this ascending support line before price did. So this forecast that price might break out of this ascending trend line. So subsequently, we saw price barely breaking out of the ascending support line, but shows strong recent bearish divergence versus RSI. So we have RSI breakout plus a bearish divergence plus price breaking out of our ascending trend line. So that gives us a high probability that price is going to continue to break out. Okay, and that's exactly what happened, and prices dropped strongly. Yeah, I'm just recovering from a cold, so I apologize if my voice sounds a bit stuffy. But if you guys can't understand me or can't hear me at any point, just let me know as well. Okay, another example before we move on, we have RSI breaking out of a descending resistance now. This isn't really a descending trend line because in order for um for it to be considered a trend line, you need at least 3 touches, and here we only have 2. So we're calling it a descending resistance instead. So on our RSI, price looks like it's breaking out. Price is currently testing the descending resistance line, and we're wondering if it's going to continue to break out. So that's the first point. Second point is that there is a descending line breakout for RSI. And lastly, there is a recent bullish divergence, which suggests that we could be seeing a strong reversal. Remember, bullish divergence because prices are making a lower low, whereas RSI is giving us a higher low. Okay, and that's exactly what happened. That's a successful breakout of the descending resistance line that's forecasted by our RSI. Any questions so far? Okay, here we have, excuse me, a bullish divergence example. So if we take a look at the screenshot on the left first, prices are moving within this descending trend channel. Prices are making a lower low, and also RSI is giving us a higher low. Okay, so that is our divergence or our bullish divergence. And we also have a 100% 50, or rather, we also have a projection, Fibonacci projection level that's in line with our resistance at this swing high here. Okay, so ultimately, if you look at the GIF, subsequently what happened is that price managed to break out of that descending trend channel and also test this resistance level that's in line with the projection because of that bullish divergence from the RSI. Okay, so here as well, another example, we have, this one is a bit more simple. We don't have that trend channel and Fibonacci line. It's basically a bullish divergence since price is making a lower low, RSI giving us a higher low, and you can see subsequently prices proceeded to move upwards. Okay, now I'm gonna briefly talk about how to use your trading journal. Are there any questions so far about RSI and stochastic or divergence? Um, talk about the 50% line on RSI and stochastic. Okay, maybe I'll just go back to my slide. Or I'll just briefly talk about it. So the 50% line can also be used as a momentum indicator on both the RSI and stochastic. So in RSI, a move above 50 signals bullish momentum. Move below 50 indicates bearish momentum. So similarly on stochastic, if prices cross over 50, it suggests increasing buying pressure, whereas dropping below 50 indicates selling pressure. So traders tend to use the 50% level to confirm your trends as well. So there can be breakouts above signaling potential uptrends and then drops below that 50%, which signal downtrends. So, you know, if if you're using both the indicators in tandem, which people often do, you can look at both of the indicators on your same chart, like we showed in the previous slide, and then see if they both align above 50 or below 50, and it strengthens your trade signals. Okay, especially when you combine it with other technical tools like your moving average or support and resistance, or if you are able to find a divergence as well. Okay, now I want to talk a bit about setting up your trading journal. Because just in case you guys were looking forward to that webinar instead. Yeah, because it was quite a last minute change. I apologize. Um, so yeah. Okay, wait. Is it safer to buy and sell to see the indicators go above or below 50% rather than use the overbought oversold? Um, I would think so, yes. Because I think that's more reliable than solely relying on overbought, which is the 70/80, and oversold, the 30 and 20 that we talked about previously. Because trend confirmation, or this 50% line, it helps to identify trend direction rather than just extreme conditions. So above 50 is you're talking about momentum. So above 50 is bullish momentum, below 50 is bearish momentum. It also avoids false signals because if you look at the overbought and oversold lines, a lot of times the conditions might lead to premature entries since as assets can stay overbought in strong uptrends or oversold in strong downtrends for extended periods. So using the 50% method helps you to avoid false signals because you're following more of a more of a trend following approach instead of just betting on the reversals. Yeah, thanks for your question. Okay, let's dive a bit into optimizing your strategy when it comes to using a trading journal or even when it comes to identifying patterns and areas for improvement in your trading. Okay, and the trading journal thing we talked about last week briefly. So this session, I'm not going to be talking about what we talked about last week, which is mostly the basics on how to set it up, choosing what software, or if you prefer a traditional notebook. I'm not going to be talking about that. We're going to talk about the best times to trade, how to use an FX calendar, and certain strategies or trading techniques that you can use as well. Okay, so the best times to trade, so it depends on market volatility and how it varies throughout the week. So you can identify which days tend to have higher volatility and better trading opportunities. And you can consider factors such as economic calendars, major news releases, and geopolitical events that can impact market movements on specific days. And then you can jot all of these information down in your journal. Okay, and you do this by providing maybe more specific examples of historically high impact trading days and their significance for the different markets that you've experienced. So one example is using an FX news calendar. So what exactly is? It allows traders to see at one glance all important economic data releases, shows us key events such as your GDP, CPI, NFP, crude oil inventories, and even central banks' monetary policy meetings. So the one on the right is the one that we normally use, which is forexfactory.com. But the one on the left is investing.com, and you can use that as well. Yeah, there are a lot of free websites that you can use. So this basically helps you to identify periods where there might be higher volatility in the markets. And you can tell based on the impact. So if it's a red flag or orange, that's moderate to high impact events. Yeah. So yellow is the lower impact events. So of course, these red and orange to red tends to have a greater effect on the markets. So let's very quickly go through some high impact events and what exactly they mean. Starting off with more US based events, we have the FOMC meetings. This is the US Fed's way of communicating their view on monetary policies. Normally comes together with a Fed interest rate decision. So if the Fed is dovish, the USD is bearish. If the Fed is hawkish, USD is bullish. If interest rate goes up, the USD is bullish. Goes down, the USD is bearish. More employment data now, non-farm payroll or the NFP measures the change in citizens that are employed from the previous month, excluding the farming industry. And unemployment rate measures the total unemployment of workforce that is seeking active employment from the previous month. More commodity-based events. So crude oil inventories measure the weekly change in the amount of crude held by US firms. If crude inventories increase, oil prices should drop. Okay. And EIA, the Energy Information Admin, is a short-term outlook monthly forecast for the year ahead. Demand and prices across major fuel types. Okay, so a couple of benefits. Helps you to plan your trades for the day, week, month ahead, and alerts you to any upcoming important news that might affect volatility. Okay, now let's talk about the best techniques to use. Some of these we go through more in depth in our specific webinars, so you can stay tuned for those. For this one, I will just be going through it very briefly, just to go through some of the best techniques that you can try out. Firstly, we have the Fibonacci. This is a checklist for you to follow when you're first starting out with Fibonacci retracements, and also some things to look out for. So firstly, is the market structure clear? You can look out for big zigzags, and we'll give you a couple of examples in the coming slides. Next is to identify the recent trend, so our price is going down or up, and it's important to always follow the general trend. Next is to identify recent major swing lows or recent major swing highs, and to connect the two extreme points from the highest to the lowest in a downtrend and the lowest to highest in a uptrend. So let me just show you a website that you can use if you're unfamiliar with Fibonacci. Okay, oh, yeah. So we do go through this more in depth in our Fibonacci series, so stay tuned for that. But for now, if you're curious to know a bit more about Fibonacci, since I did touch on it and I use it in every single one of my charts, yeah, you can feel free to look at this website. It's just the forexarmy.com, how to draw a Fibonacci retracement correctly. I'll just pop the link in the chat. Okay, it's completely free to use. We have some YouTube videos that you can look at and some guidance as well on what to look out for when you're plotting a Fibonacci trend line. And with Fibonacci trend lines, there are essentially 4 different types of techniques that you can use with just this one indicator or one tool. So yeah, I won't go through all of them now, but you can take a look at this for now in the meantime we before we do our Fibonacci series. So if you guys are unfamiliar and you want to see that, let me know as well. And we can definitely do that in the coming weeks. Okay. Okay, let's do a bit of a recap. Last week, I did mention a bit about where is the proper placement for your take profit and stop loss. So you should always place your stop loss beyond a confluence area or a major resistance area, and place your take profit before any major resistance area. Reason is so that you are able to maximize your profits and limit your losses because of price tending to be attracted to these areas of confluence but might not be able to push past them. So today's session, I'm going to talk a bit about another technique that I did mention last week, which is our trailing stop loss. So a trailing stop loss is a type of stop loss order that is set at a certain percentage or dollar amount away from the market price. So the idea behind a trailing stop loss is to lock in profits while giving the trade room to breathe, as the stop loss follows the market price as it moves in favor of the trade. So the trading stop loss technique can be useful because it allows you to manage risk and lock in profits dynamically as the market moves. So it's different from a fixed stop loss, which is set at a specific price and doesn't change as the market moves. And these are the different types of trailing stop loss that you can use. We'll go through a couple of these today. Firstly is the moving average indicator. Secondly is parabolic star, chandelier, and ATR, support and resistance levels, and also a combination of these methods. So when it comes to using your journal, you can feel free to use these different types of stop loss and then jot down which works best for you, especially when you're first starting out. Okay, so moving average, you can see in this example, price is moving in this ascending trend line. Price is moving in this ascending trend line, but it's starting to break out of it and out of this resistance level as well. Excuse me. So we're going in for a sell entry here. And you can see price moving below our moving average really nicely. And our trading stop loss is triggered once price crosses above the moving average. So it got us out before prices started to increase. Okay, trendline breakout, pretty similar concept to earlier. Here prices are moving below the descending trend line, and our trading stop loss is triggered once price crosses over this line. Okay, parabolic star, also the same concept. Okay, and chandelier and ATR, also kind of the same concept. And we're looking at the same chart as well. So it should be quite straightforward. Okay, in this example, same thing, prices are moving below this overlap line, and it's also breaking out of our ascending trend line. So we're going in for a sell entry towards our take profit here. You can see using our moving average as well, prices moving below, and our take profit is met over here. Okay, so you can also use breakouts as trading stop loss. Breakouts are usually high volatility events. Price can spike up and reverse almost as quickly, and a stop loss will help you to manage risk and protect your capital. Trading stop loss can also help you to protect your profit. Just give me 1 second. Okay, so when it comes to breakouts, we already talked a bit about breakouts when it comes to divergence. So you can combine that with what we've learned earlier as well. So here, let's talk about trend trading. So here's how it works. Firstly, you want to identify a trend in the price movement of a currency pair. So this is typically done by analyzing historical price charts, and that's where your trading journal comes into play. And an uptrend is characterized by higher highs, higher lows, downtrend, lower highs, and lower lows. Next is entry points. So in an uptrend, you might look to enter a trade when the price has retraced, so pulled back slightly from its recent high, anticipating that the trend will continue. In a downtrend, you might look for a retracement before the price continues its downward movement. So now let's look at setting stop loss and take profit levels. That's point 3. So this is more to manage risk. So it's crucial to set your stop loss and take profit levels at certain points. So I already kind of recapped with you guys a bit about the proper stop loss take profit placement. Or if you choose to use a trailing stop loss, like we went through earlier, that's up to you as well. Yeah, just make sure you know where exactly and the reason behind why you are using that specific method. Number 4, riding the trend. So once you're in the trade and the trend continues, you aim to stay in the trade as long as the trend continues or remains intact. So this involves monitoring the price movement and adjusting your stop loss and take profit levels if needed. Next is exiting the trend. So eventually the trend will likely reverse or weaken. At this point, you might decide to exit the trade and take your profits. Okay, so these are all things to record down in your trading journal as well. And lastly, number 6, practice and analysis. So like any trading strategy, um, trend trading or trading stop loss, these all require practice and analysis to see what works best for you. So keep refining your skills and recording your success and also your failures from each trade, and stay updated on market news that could impact currency prices. Okay, so now that we're talking about trend trading, the most basic would be how to draw valid ascending trend lines. So I talked about this slightly earlier, that trend lines should at least have 3 significant touches. And for ascending trend lines, it should be from bottom to top. Something like this or like this. Descending trend lines should be from the top as well. So your trend lines should at least have 3 significant touches. 2 touches tend to be more coincidental. Okay, so these are some examples. Okay. So over here, you can see price playing the reaction of that 4th touch. Okay, so let me know in the chat if you guys think that this trend line is valid. Okay, so this trend line is actually not valid because like if we mentioned earlier, let me go back. For descending trend line, it needs to be from the top. Okay, whereas here we are drawing it below. So it should be drawn from the top to be considered valid. Okay, now really quickly we'll go through drawing valid trend channels. So channels require at least 4 touches, 2 at the top and 2 at the bottom. But they don't have to be consecutive like this. So something like that or like this. So in the next couple of slides, I'll talk quite briefly about the different indicators that you can use to identify your trend. And then you can try it out on your own. And also see if, choose what sticks. If it doesn't stick, just don't use it. Okay? Really quickly, let's talk about Ichimoku. So we are going to do an entire webinar on this, I think, coming up. But I'll just briefly break down the lines. So it's composed of 5 lines of calculations. 2 of which comprise a cloud where the difference between the 2 lines is shaded in. So the cloud is the key part of the indicator. So I'm going to skip past talking about the different lines for now, because we're running out of time. I'm just going to tell you the buy and sell signals. Okay, or how to use it effectively. So the overall trend is up when price is above the cloud. And when price is below the cloud, then price is considered to be down, or the trend is downwards. It's transitioning or trendless when it's moving within the cloud. And this is how I typically use it as well, because at one glance, you can see exactly what the signal is. So it's very quick and easy to use. So traders will often use the Ichimoku cloud as an area of support and resistance, depending on the relative location of the price. The cloud provides support and resistance levels that can be projected into the future. This sets the Ichimoku cloud apart from many other technical indicators that only provide support and resistance levels for the current date and time. So this is an example. Okay. Another example is price and the moving average cross. So very quickly, the price XMA cross is very simple trend following strategy, and we talked about this earlier as well as a trailing stop loss. So I won't get into how exactly it works. I'll just tell you the buy signal is when the shorter MA crosses above the longer MA. It's just a potential upward trend. Sell signal is when the shorter MA crosses below the longer MA. It indicates a possible downward trend. So for example, if you choose a 20-day MA and a 50-day MA, right? So if the shorter time frame, which is 20, crosses above the 50-day, which is the longer time frame, it's a buy signal. If it's the other way around, or the 20-day crosses below the 50-day, then it's a sell signal. So this strategy works best in trending markets. Okay, so again, you should use this in conjunction with other indicators as well. Okay, and lastly, golden death cross. So this is a trading strategy based on the intersection of two important moving averages based on a price chart. So it's a term used to describe the point at which a shorter term moving average crosses above a longer term moving average, indicating a potential bullish trend reversal. And the death cross is basically the opposite. So where the shorter term moving average crosses below. Okay, so this should be used more as a confirmation um, of your analysis already, and it shouldn't be used solely on its own. Okay, so when it comes to using your trading journal, you can look through all of these different types of moving averages. Um, yeah, moving averages or the different indicators, and just see or jot down your successes and see what works for you. Okay. Okay, that's all I have for you guys for today. Let me know in the chat if you guys have any requests for the upcoming webinars, any specific topics or indicators that you'd like me to go through more in depth. Just let me know in the chat. If not, that's all I have. Thank you guys so much for joining me. Have a great Lunar New Year for those of you guys who celebrate. And yep, I will see you guys again next week. Thanks, everyone. Okay, gun angle. I'm not very familiar with that indicator, but I can take a look at that. Okay, thanks everybody. See you guys next week. Bye. Thanks everyone.